Hello and welcome to all our viewers on CFO Insights. I am Sherry, a financial technology consultant at Hyperbots, and I'm very excited to have Jon Naseath here with me, who is an accomplished executive with expertise in AI, machine learning, and computer vision, driving impactful technology solutions in education, healthcare, and business. Thank you so much for joining us today, Jon. Our discussion will focus on the differences, similarities, and reasons for variations in the chart of accounts across different ERP systems. Let's dive right into it. Can you briefly explain what a chart of accounts is and its importance in financial management?
Sure. So I approach the chart of accounts a little differently than others might because I have this background in information systems. And so from my perspective, the chart of accounts is kind of like a master data table that defines a standard structure that you're going to use for how you want to manage your business. In the simplest way of thinking about it, it's a listing of the most detailed level that includes all P&L records, like the drill down to the P&L at the base level. And then also it also includes the drill down for the balance sheet at its base level. So, but it includes all of them. And then from there, you're going to have other tables that will have, accounts receivable and accounts payable and other subledger, they're called. So general ledger, chart of accounts, subledger. And this chart of accounts is the master data that you use to the structure you're going to follow for how you're going to roll everything up to the P&L and balance sheet. Just one more piece there. So if it's the most detailed level down, then you might have like, here's these 5 types of revenue that you have, and then you'll roll them up to be, here's your revenue number in a financial statement as an example, or whatever the summary numbers are you see in your management reporting. Core foundation of those financial statements is your chart of accounts.
And in your experience, how would you say the chart of accounts structures differently across the 5 ERP systems like Sage Intacct, QuickBooks Online, Dynamics, SAP Hana, and NetSuite?
The way I would describe it is that each of those companies have a default out-of-the-box chart of accounts that they'll present to you as a potential customer using their product. And each of them have different target markets. So, QuickBooks, Sage, Intacct are trying to solve they're focusing on one business entity at a time. And so they want to present a relatively simple chart of accounts, while SAP Hana, Dynamics, NetSuite want to present that they have this flexibility and they can handle more complex businesses and more dimensions, really is what it talks about. So the reality though is with rare exceptions, I've ever seen a company who can just adopt whatever is the chart of accounts from any of those systems and then adopt it using straight going forward. I'm sure you'll ask another question about it, but usually there's some level of customization that's required anyways. So the system's really just saying, what's the best way we can give a starting point for that customization for whatever our target customer needs are.
And why would you say ERP systems like SAP HANA and Dynamics have more detailed and segmented GL codes compared to others like QuickBooks Online?
From my perspective, and from a pure database design perspective, they're not actually different. It's just designed for how you need to support the customer. They're still going to be your revenue, the numbers that are applicable for your business. There are ones that are designed to support businesses that have, like before I was at a company that built giant data centers, and we would have different parts of a dimension for each data center. So it comes down to what are the different ways that you want to slice and dice that chart of accounts, and what of that slicing and dicing dimensions are you going to build into your actual chart of accounts codes versus which ones are you going to have as other subledgers and outside of your general ledger chart of accounts.
And how do localization requirements affect the chart of account structures in different ERPs? And could you provide an example?
Yeah, so like NetSuite, SAP HANA, oftentimes are designed and adopted to support global operations. And so there might be different tax codes, GAAP rules, IFRS. A lot of times you'll design your chart of accounts in a way that can support whatever roll-up is needed. And you'll roll up differently for taxes, you'll roll up differently for management reporting. This is kind of your source of truth for how things were recognized as revenue, how costs were expensed. And so QuickBooks, as an example, might focus more on the US market, and it's going to try to present a more structured, simplified thing so that people will seem like it's very understandable. While when you get into a larger global organization, it's just not sufficient. You can't, basically you'd end up having lots of little entities, and then how do you roll those up? And I've been in that situation where that roll up happens in Excel and you're trying to consolidate. So this concept of a financial statement consolidation by a centralized core team, that's enabled and possible because of the additional complexity of SAP, Oracle, and those other larger systems, when the reality is it's actually much simpler to do that versus having to have lots of different entities in the system and then manually having to extract and roll things up, which having done is painful.
As you touched upon customization in ERP systems, what role does customization play in determining the differences in chart of accounts across these ERP systems?
Two quick examples come to mind. I was working with a company this last week, actually talking to their finance person about how they had actually been on NetSuite, but they were a smaller organization and NetSuite's somewhat expensive for them, they felt. So they got a new, you hire a new controller or a new finance leader, and they think they're adding value by changing the system. They're like, oh, this doesn't work, let's put a new system in. So basically they got them to switch off of NetSuite to QuickBooks. And now they're just running into a lot of the complexities like I described before. It's a standard chart of accounts. It's not flexible enough to do some of the things they need for different locations, different vendors. And so basically they're trying to figure out, and then it's just a standard one. So it doesn't even it doesn't represent their revenue streams. So you end up having to use other tools to map the chart of account things to your revenue streams, map other dimensions, create these, I'll call them fake dimensions within the code itself to say, this is this type of revenue, this is this type of revenue based on number sequences and things. And then it just becomes what I like to describe as a bloated chart of accounts. You have kind of the worst example that oftentimes happens is when somebody decides we're going to put all of our products in as different codes in the chart of accounts for all our types of revenue. And you end up having so many different types of accounts in there, chart of accounts records. And the accounting team thinks it's going to be great. They're excited. Having seen that, 9 months, a year later, maybe 2 years later, your accounting people are just tagging stuff to whichever is the simplest code anyways. And you end up having all these codes that aren't even used. And again, it's less about the individual systems from my point of view and more just the complexity that you're trying to match the business operations, the actual business flow. And does that chart of accounts represent that business flow? Is it simple, or do you need a more complex business flow based on what your business model is?
And just like we talked about the differences, can you also discuss the similarities in chart of account structures across these ERPs and why these similarities are important?
So at the end of the day, it's a P&L and it's a balance sheet. And you're talking about revenue, you're talking about cost of revenue. Maybe based on your business model, you have certain gross sales that happen before you get to actual GAAP revenue or IFRS revenue. And then you go from there down to cost of goods sold, gross margin, operating costs, operating income, whatever is your P&L for your business, that's what you need your chart of accounts to support. That's what you need your GL to support. And then the second part to that is your balance sheet. And the real beauty of a chart of accounts is that it includes both. So when you make an adjustment up here, it's dual entry stuff. You make an entry up here, it enters down there in the balance sheet also, and it nets everything out. And it's a little hard to wrap your head around when you first get started. People have whole degrees in accounting so they can understand it. But maybe this will sound like I'm egotistical, but when it clicks, it's not that complicated. It's pretty simple. And again, from a systems perspective, I'll talk to technical engineers. It's just another table in your database. It's a master data table like customer, like dates, like any other master data. But this is the master data fields for how you're going to run the the operations of your business.
Could you also provide a specific example of how a particular industry might benefit from the unique chart of account features of an ERP like SAP Hana or Dynamics?
Well, SAP HANA is really known for a long time ago, SAP cracked the code on inventory management. I've seen companies using, maybe Oracle I'm sure people with Oracle will claim they've done great with it now also. And I do know that QuickBooks has a pretty good basic level inventory management system. But SAP for a while has been known for, how do you track costs per revenue, per product line, per region, per business unit? And when you get into managing that business, that becomes important to be able to understand the profitability and managing each of those dimensions of your business, especially globally. Microsoft Dynamics has similar capabilities and can also do multi-dimension. The real trick here is, are you going to try to bake all of that complexity into individual codes and have these long codes that mean different things? Or are you going to have, from my perspective, even when you do that, there's a simple part of that long string of code that represents revenue and things. And then all you're doing is parsing out that other part that maybe seems complex into other dimensions that aren't part of your GL. It's part of a product table and anyways, other stuff. So when you can wrap your head around it, it's all pretty straightforward. It's just how do you manage it within the system that you're given.
And why might a smaller company, in your opinion, prefer an ERP like QuickBooks Online or Sage Intacct over SAP Hana or NetSuite?
I was sitting down recently with the founder, CEO of a nationwide company here in the US, and it's pretty good, big operations. We were talking about something, and he was just able to pull up his full dashboard. It showed everything right there at his fingertips. And I know all the other systems can do that too, but when your business operations are fairly straightforward, fairly simple, it has all the feature functionality, bells and whistles that you need. It's just when you get a little more complicated, then you need other plug-on tools.
And how do integration needs impact the differences in chart of accounts across these ERPs? And can you provide an example for the same?
Okay, now that wasn't planned, but that was actually the next thing I was going to bring up. So that's cool. Oftentimes, when you're talking about the ERP systems, it's kind of this catch-22 because you have your accounting team that wants the data from throughout the business. And so, maybe 10 years ago, the plan was, well, let's get everyone Oracle licenses within accounts payable. Let's get everyone, whatever, even different business leaders outside of accounting finance needed to have access to that ERP system. And I'm sure ERP sales reps really want that to be the case. But I think this kind of somewhat fell apart when the ERP system started buying other integration systems. So now you have like your HR system and you have your expense management system and you have these other tools, which bluntly, I'll just say, have a little bit nicer user interface a lot of times, a little bit user ease of use, and maybe apps that are really cool that they're very focused on that use case for a certain business role. And then those systems, which back in the day, we used to custom build these things just so that people would actually use them, because there's nothing worse than making someone log in and then click and then click and then click and then click, and then finally you get to the part you need. So give them what they need, simple user interface, but then that can feed what it needs straight into the general ledger, chart of accounts where needed, or subledger, make sure it gets coded correctly and avoid a lot of errors.
And looking forward, how do you see the differences in chart of accounts across ERPs evolving as businesses continue to grow and adopt new technology?
I think a lot of the challenge that I'm seeing is businesses are evolving quickly. Their business models are evolving quickly. They're doing M&A, they're adding on new revenue lines, they're cutting costs, they're adding on a new division. So every time you do that fundamental change to a business, I'll say in theory, your chart of accounts should update or align to support that also. What oftentimes happens is it doesn't. And so you end up doing this like, well, let's create a new account code and we'll tag everything into that. And then these other ones are old ones. We're not using those. And so there's this idea of cleaning up the chart of accounts. It's oftentimes just gets delayed, out of sync, and isn't applicable. So I think where technology can help is a lot of times in that scenario I was describing, accounting, finance, more likely finance ends up having to create a mapping of what was the chart of accounts in a spreadsheet to what our management reporting needs are and how we're going to parse things out. And then we have maybe allocation logic based on how we're going to allocate a line to different departments or divisions or locations. And that's all fine, but you're doing it manually. And what I think that AI and technology is going to be able to do is make it so you can say, and it's not going to, it's happening now. I'm seeing it happening in technologies. It can take whatever is that chart of accounts, and as long as you have evidence of how you've mapped it historically and you can kind of train it on what you need, it'll give you the management reporting piece. So a lot of this manual mapping and then revenue numbers being off or account numbers being off because it was mapped manually wrong or someone made an error in a cell linking, or trying to extract the data into your whatever FP&A type reporting tool and then mapping it from that ETL into your reporting system. All of that can be simplified so that as you change your business or as you ask the example AI a question, it can logically figure out down even to what transactions should map over to that reporting. It might even in theory, bypass the GL in some cases. Because just one more point there, the GL is a summary view that goes down to a certain level of granularity. But a lot of people are wondering, why is accounting taking so long to close the books? Because they're going around trying to reconcile that to the bank, to the subledger, to all these different, every other thing that all the rest of the business has spent the whole month doing. They're supposed to be able to instantly tie all that out and make sure that the GL is correct. In theory, actually, it's not theory, I've seen it. AI can take directly from your subledger, accounts payable as an example, give you the reporting you need, and then make sure that it ties to your GL and make sure your GL is complete and accurate. So all this manual error or mapping inconsistencies, and frankly, a lot of what auditing is meant to do and accountants spend a lot of times learning how to do, you shouldn't have the same errors that you had in the past as AI is able to automate a lot of that stuff.
Thank you so much for these insights, John. It's clear from this conversation that the differences in chart of accounts across ERPs are shaped by a variety of factors, from the size and complexity of the business to the need for localization, customization, and integration. This conversation has been incredibly informative for understanding how businesses can choose the right ERP for their financial management needs.